Thanks, Ryan. So yeah, hello and welcome again to this evening's live event, Investing Like a Stock Superstar. My name is Derek Hageman. I'm a financial analyst at AAII, and I'm the editor of AAII's Dividend Investing, and I'll be serving as tonight's moderator. The American Association of Individual Investors is an independent, nonprofit group that helps individuals become effective managers of their own assets through programs of education, information, and research. This weekly webinar series is an extension of AAII's educational mission and allows us to reach members and individual investors literally around the globe. It is my pleasure to introduce tonight's speaker, Wayne Thorp. Wayne has his CFA designation and is the lead analyst and editor of the Stock Superstars report. He is also the senior financial analyst and a vice president at AAII. He has written extensively on technical analysis, quantitative stock screening, and fundamental stock analysis. Wayne is also the product manager for the A+ Investor Investment Discovery, Analysis, and Tracking Service, and for the Stock Investor Pro fundamental stock screening and research database software. Wayne also serves on the Dividend Investing Advisory Committee and serves as the Vice President of the Alliance for Investor Education, AIE. Welcome, Wayne, and thank you for joining us.
Thank you, Derek. I think you might need some oxygen for all of that bio background.
Well, you have recently celebrated your 25th anniversary at AAII, which is fantastic. And, you know, with everything on your plate at AAII, I see that you did actually find some time to get a haircut, or as you like to say, your ears lowered. So I guess that makes two of us, and definitely it's the small things that give us a sense that we're getting back to a sense of normalcy.
Absolutely, it's been a couple of months, and yeah, Derek, you're looking great as always. So yeah, it is nice to slowly get back to a little bit of a sense of normalcy. Though I did, my first haircut wearing a medical mask, so still practiced proper social distancing there. But yeah, it's nice to get the locks cut off a little bit.
Definitely. Well, I don't think people really want to hear about our hair grooming styles. So with that, please take it away, Wayne, and let us know how to invest like a stock superstar.
Thank you very much, Derek. Good evening, everyone, and welcome to the latest installment of AAII's Wednesday webinar series. As Derek said, my name is Wayne Thorp, and I'm the Senior Financial Analyst here at AAII. I want to thank all of you for joining me tonight as I discuss one of my true investing passions, quantitative stock selection. As Derek alluded to, I recently celebrated my 23rd anniversary, and actually since my first day at AAII, which was April 1st, 1997, I've been involved in selecting stocks using software-based and online tools. Since then, I've been involved with AAII's fundamental stock screening and research database program, Stock Investor Pro, and for the last 10 years, I've served as its program manager. I've written countless articles on stock screening and analysis, and have had the good fortune of speaking around the country, giving dozens of presentations on the subject. Tonight's program is an extension of the work that I've done with AAII stock screens over the last 20 plus years. So please sit back, relax, and I'm going to switch off my webcam to give you an uninterrupted view of tonight's slides. So with that, let's begin. Many of the stock screens AAII has developed over the last 2 decades are based on the strategies of stock superstars. These tend to be professional investors and money managers. However, there are some academics thrown in for good measure. These gurus use or have used a systematic approach to selecting and analyzing stocks, and several of them have outperformed the market over many years. As an AAII member, you have access to over 60 stock screens. 40 or so of which are based on the methodologies of investment gurus such as John Templeton, Benjamin Graham, T. Rowe Price, and David Dremin. The results of these screens are updated monthly through the last trading day of each month. We also provide you with the companies that pass the quantitative filters tied to each screen. Here on slide 5, you'll see a sampling of the companies that pass the AAII O'Shaughnessy Tiny Titan screen as of the close of June 8th. In addition, we calculate a variety of risk and performance data over varying time periods dating back, in most cases, to the start of 1998. So here on slide 6, we see the cumulative return graph of the Tiny Titan screen dating back to the start of 1998. Lastly, and perhaps most importantly, is to recognize that these are not black box systems. We list the exact filters used for each screen and provide educational resources for each screen that we have developed and track, outlining the strategy and the rationale for the underlying filters of each screen. But ultimately, the focus of tonight's program is the methodology of one specific investment superstar guru, and his name is James O'Shaughnessy. Jim is the founder and co-chief investment officer of O'Shaughnessy Asset Management, which had $5.7 billion under management as of the end of 2019. OSAM grew out of Jim's near obsession with quantitative stock selection and analysis. In fact, he calls this investment methodology fundamental quant. His decades of research have led him to being recognized as being a pioneer in the field of quantitative equity analysis. He is also incredibly generous in sharing his knowledge with individual investors. Jim has been a friend of AAII's for many years, writing numerous articles for the AAII Journal and speaking at our national programs. In 2019, AAII awarded O'Shaughnessy the Clunan Award for Excellence in Investment Education. Tonight's presentation will focus on some of the research he put together for the 4th edition of his best-selling book, What Works on Wall Street, which AAII has parlayed into a quantitative stock selection strategy that we use for one of our premium portfolios. One of the many things I have learned as both an investor and an analyst over the last 2 decades is that it is far better to keep things simple than try to overcomplicate the stock selection and analysis process. Having a systematic approach to investing, in my opinion, will yield better results than a hodgepodge approach ruled more by your gut and emotions. Perhaps it's for that reason that O'Shaughnessy's message resonates so strongly with me. Jim outlines 2 seemingly simple keys for investment success. First off, find a great strategy, and secondly, stick with it through thick and thin. If only investing were that simple though, right? Successful stock investing requires a great deal of discipline, especially if you are following a systematic selection strategy. Show me a stock picking strategy with excellent long-term results, and I can, with almost absolute certainty, point out periods where it underperforms the overall market. In some cases, this underperformance can last for years. It takes a lot of discipline to stay with a strategy that underperforms the market for months or even years. However, this is the price we pay for that long-term success. Unfortunately, many investors lack the discipline and conviction to stick with a strategy through the entire investment cycle. And to speak from my own personal experience, I know it's very difficult to, you might find a screen or a strategy that you feel very strongly about, but when those periods of time when it starts to falter and fall behind the market, it does become very difficult to stick with it. But that's where that discipline comes into play, and the conviction and the belief in the system that you're following. Giving up on a strategy when it is underperforming, no matter if it's weeks or even years, That's oftentimes why many of us fail to beat the market. It is my firm belief that discipline is just as important as investment knowledge when it comes to long-term success. If you were to pick up any of the 4 editions of O'Shaughnessy's book, What Works on Wall Street, you will find a common thread running through all of them. As a quant, Jim has spent his career analyzing stock characteristics to see which are the most profitable to use when selecting stocks. These characteristics have actually come to have a name, and they are called factors. Today, by some counts, there are thousands of factors that professional money managers and individual investors can use to select stocks. But some of the most common, and those that you're probably familiar with, are value, quality, financial strength, growth, and momentum. Jim O'Shaughnessy is a strong advocate of value investing, and much of his research revolves around identifying those value factors that are most useful and profitable when selecting winning stocks. There is a mountain of academic research as well as the long-term performance of several well-known investors, which has proven that value investing does work. Value investing involves buying stocks that are trading well below their fundamental value based on sales, earnings, book value, cash flow, or dividends, etc. However, just as stock selection strategies fall into and out of favor, so too do individual investment factors. Research also shows that other factors have become less effective over time due to accounting changes and structural changes in the market. In an incredibly candid article that O'Shaughnessy wrote in June of 2018, titled "Mistakes Were Made, and Yes, by Me," he states that one of the biggest regrets he has in his professional career was labeling the price-to-sales ratio the quote-unquote king value factor in the first 3 editions of What Works on Wall Street. Always willing to evolve as an investor, O'Shaughnessy's research for the 4th edition of What Works on Wall Street uncovered that by combining multiple factors into a single composite yielded better, more consistent, and less volatile results than relying solely on one factor. So he created several composites that address a stock's valuation, financial strength, and earnings quality. These 3 elements are the foundation of AAII's multi-factor O'Shaughnessy selection strategy, which I will discuss a little later. For now, let me walk you through these 3 composites we use for our O'Shaughnessy multi-factor stock screen. The first composite that O'Shaughnessy discusses in What Works on Wall Street covers value. His analysis combines the ranking of 5 popular value measures into a single metric. These metrics being price to sales, price to earnings, enterprise value to EBITDA, price to free cash flow, and shareholder yield, which is dividend yield plus the rate of share repurchases. AAII then added in the price to book value ratio in creating our own value composite. You are probably familiar with most of these measures, with the possible exception of enterprise to EBITDA and shareholder yield. So for the sake of time, I'm just going to just offer a brief description of these 2 metrics. Enterprise value to EBITDA is used as a valuation tool to compare the value of a company, debt included, to the company's cash earnings less non-cash expenses. It's ideal for analysts and investors looking to compare companies with the same industry. But when it is included in a composite such as this, the impact of any industry bias is reduced. Enterprise value is a measure of a company's total value, often used as a more comprehensive alternative to equity market capitalization. Enterprise value, or EV, includes in its calculation the market capitalization of a company, but also short-term and long-term debt, as well as any cash in the company's balance sheet. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a measure of a company's overall financial performance, and it's used as an alternative to simple earnings or net income. For asset-intensive firms, EBITDA, however, can be misleading because it strips out the cost of capital investments, such as property, plant, and equipment. Just like the PE ratio, the lower the EV to EBITDA, the cheaper the valuation of a company. Shareholder yield is a valuation measure that aims to capture the benefits of both dividends and share buybacks. Shareholder yield is the sum of a stock's dividend yield and the percentage of net share buybacks over the previous 12 months. It is a useful tool for identifying good management teams. The rationale being that the market usually doesn't react kindly to cuts in dividends or a suspension of share buybacks, so managers usually want to ensure that the company is on sound financial footing before implementing either one. Slide 16 shows the performance of a variety of value factors dating from 1963 to 2018, with data provided by O'Shaughnessy Asset Management. You can see where no one factor performs the best over all of the different time periods analyzed, nor does one consistently lag over all periods. The biggest takeaway from this slide, however, is that creating a value composite doesn't significantly lower the performance relative to the best performing factor for each period, but does substantially outperform the lower performing factors for each period. To realize the best return for each period, however, you have to be able to pick the winning factor, which is a near impossibility, in my opinion. Likewise, if you are unlucky at picking the best factor, the composite increases your overall performance versus investing in the single poorest investment factor. As a long-term value investor myself, I recognize the fact that many stocks do deserve to trade with rock-bottom valuations. That is why I'm always an advocate of adding qualifying elements to any approach that looks for deep value stocks. O'Shaughnessy, too, realizes the importance of selecting quality companies that are trading at attractive valuation levels. For that reason, he also created composites that look at a company's earnings quality and financial strength. These two composites are useful at removing stocks that you shouldn't own. Analyzing a company's earnings quality attempts to weed out firms where management is using aggressive accounting practices. While they may be operating under the rules of generally accepted accounting principles, or GAAP, they offer an indication of a corporate culture that could lead to bigger issues down the road. Studies show that companies with aggressive accounting practices, all else equal, tend to underperform companies that follow more conservative accounting standards. Just as he did for the value composite, O'Shaughnessy created an earnings quality composite. For it, he used 4 factors that his research shows outperform the broad stock market over the long term. The factors he uses for the earnings quality composite focus primarily on the company's income statement and cash flow statement. Those factors are current accruals to total assets, change in operating assets, total accruals to total assets, and depreciation to capital expenditures. Without diving too deeply into accounting principles, I do want to give you a brief overview of some of the concepts that are highlighted here, some of which you might not be familiar with. Accruals are revenues earned or expenses incurred, which impact a company's net income on the income statement, although cash related to the transactions has not yet changed hands. Accruals also affect the balance sheet, as they involve non-cash assets and liabilities. Accrual accounts include, among many others, accounts payable, accounts receivable, accrued tax liabilities, and accrued interest earned or payable. Operating cash flow is a measure of the amount of cash generated by a company's normal business operations. Operating cash flow indicates whether a company can generate sufficient positive cash flow to maintain and grow its operations. Otherwise, it may require external financing for capital expansion. One method of calculating operating cash flow is to start with net income and then make adjustments for non-cash expenses such as depreciation or changes in working capital, current assets and current liabilities, such as accounts receivable and accounts payable. For the average investor, though, these terms may be unfamiliar and possibly even intimidating. That's why when Jim was writing an article based on his research for the AAII Journal, he came up with an alternative measure of earnings quality that simply examines the difference between a company's cash from operations and its net income over the trailing 12 months. He then scaled it using the company's market capitalization. The closer a company's operating cash flow and net income are, the smaller the ratio. This means there are fewer adjustments to net income that reflect the accounting assumptions made by management. This, in turn, indicates a more conservative accounting approach, which is an indicator of higher corporate quality. The last composite score O'Shaughnessy created that I want to talk about this evening deals with financial strength. The financial strength score shifts the focus from the income statement and cash flow statement and looks at a company's balance sheet, specifically its debt levels and its ability to meet its obligations. O'Shaughnessy's financial strength composite uses 4 factors: long-term debt to equity, cash flow to long-term debt, external financing, and the 1-year change in long-term debt. Cash flow to long-term debt is a coverage ratio, which measures a company's ability to meet its interest payments. As a proxy for this, AAII's financial strength composite makes use of times interest earned, which measures how well a company can generate earnings to pay the interest expense on its debt. The external financing measure is a ratio of cash from financing to total assets. Cash from financing comes from the cash flow statement and measures the inflows from additional borrowing, repayment of debt, dividend payments, and equity financing. It is better to avoid companies that finance from external sources rather than through internally generated cash flow. When evaluating the external financing of a company, lower ratios are desirable. So now, having covered the O'Shaughnessy composite scores and how they were developed, I want to shift gears now and look at a company that rates highly across the value, financial strength, and earnings quality composites. That company is Navient, ticker NAVI. Navient is a leading provider of education loan management and business processing solutions for education, healthcare, and government clients at the federal, state, and local levels. The company is in the consumer lending industry and is part of the S&P Midcap 400 Index. So now I'm going to walk you through the 3 different composites using data for Navient as of the close of June 3rd, 2020. As of that date, Navient had a value score of 16, with 1 being the best. The score ranges from a score of 1 to 100, with 1 being the best. Navient's score is based on the following data. The company has a price to sales ratio of 0.99, which ranks in the 37th percentile, a PE ratio of only 5.3, which ranks in the 7th percentile, a price to book ratio of 0.8, which ranks in the 24th percentile, a price to free cash flow ratio of 1.6, which puts it in the 5th percentile, and a shareholder yield of 25.8%. And that's based on a yield of 7.8% as of the close on June 3rd, and a buyback yield of 18%. And this shareholder yield of 25.8% places Navient in the 1st percentile of all US listed stocks. Lastly, the enterprise value to EBITDA ratio for Navient is 129.2, which puts it in the 98th percentile. Now, when I saw Navient's enterprise value to EBITDA ratio, I was really surprised given the low values for the other value factors. So when I see things like that as an investor, as an analyst, I immediately, my spidey senses go off, and this is something I definitely have to look into. So I started poking around with the company, and then recognized the fact that as a consumer lending company, this really is not surprising that its enterprise value is so high relative to its EBITDA. This is because the company had $81.7 billion in long-term debt as of the end of 2019. However, 82% of that has been securitized, as it securitizes its portfolio of student loans. This highlights that certain ratio levels are impacted by the industry in which a company operates, and that if we were relying solely on this ratio instead of the value composite, we would have bypassed a company that, at least based on its 5 other value measures, does look attractive. This also shows that you shouldn't necessarily take a metric at face value. You need to be prepared to roll up your sleeves if you see an anomaly such as this in order to put it into context. We now move on to Navient's earnings quality score, which is 87, with 100 being the best. The company generated $1.28 billion in cash from operations over the trailing 12 months, while its net income over the same period was $364 million. This means that non-cash items and changes in working capital amounted to $920 million in accruals over the last 4 quarters. Apologize for that. Scaling it by its market cap of $1.71 billion gives us a ratio of 0.538, or 53.8%. Remember, the lower the value, the better. Ranking this value against all other US listed stocks, whereby the lower ratio receives a higher rank, Navient's ratio ranks in the top 13% of all US listed stocks. Lastly, we look at Navient's financial strength score. With 100 being the best, Navient scored an 89 as of the close on June 2nd of this year. The company doesn't have a valid debt-to-equity ratio because of its outsized level of long-term debt, again tied to its securitized loan portfolio. And because of the interest it generates on its loans, it actually has a net interest income and not an expense. So its coverage ratio is not applicable in this case. However, Navient's cash from financing relative to its total assets ranks in the 89th percentile, with 100 being the best. The company paid out more in financing activities than what it took in over the last 12 months, leading to negative cash from financing. Had it been a net issuer of stock or debt, relying on external sources of funding, this figure would have been positive. We like to see low or negative values for this particular ratio. Tied to that, the company has lowered its level of long-term debt by nearly 8% over the last year. And incidentally, through my research and reading through company reports, paying down its debt is a high priority amongst management. So this concludes my discussion of the background of the O'Shaughnessy composites and my featured companies selected using these composites. In the time I have left, I want to touch on how we're using O'Shaughnessy's research at AAII to manage a 10-stock portfolio within the Stock Superstars report, of which I'm the lead analyst and editor. If you're interested in what I have talked about tonight, AAII has a portfolio that I manage using these particular composites. For those of you that aren't familiar with the Stock Superstars report, it uses 4 different selection strategies, each one based on a superstar guru, one of them which being the James O'Shaughnessy multi-factor approach. The SSR portfolio is actually comprised of 40 stocks, 10 stocks in each of the 4 different portfolio groups. For the O'Shaughnessy portfolio, we isolate from our 6,100 stock universe those that rate in the best, quote unquote, 20% in terms of the value, financial strength, and earnings quality composites. From this list, we then filter out stocks that present liquidity concerns to arrive at the investable universe of stocks, which is usually about a dozen or so at a given point in time. I then do additional qualitative reviews of these stocks to arrive at those that ended up on our watch list and the actual portfolio. I also use defined quant rules based on these 3 composites to help guide me when it is time to remove a stock from the portfolio. While the actual SSR O'Shaughnessy portfolio is comprised of 10 stocks, I also maintain a watch list from which I choose replacement stocks if and when we have to remove a stock using our quantitative sell rules. This makes my life easier when selecting new stocks because I have a corral of stocks from which to pull from that have already gone through the vetting process. But it also offers subscribers an additional collection of investment ideas if they choose to look beyond the actual 10-stock portfolio. Some of the other elements of the SSR portfolio that are worth noting is that all 4 groups do rely on quantitative selection strategies based on 4 different investment gurus. And actually in the coming weeks, I will be discussing the 3 other gurus that we use in the portfolio, those of strategies of William O'Neill, David Dreman, and John Neff. On a weekly basis, we potentially can issue deletion alerts based on our quantitative sell rules. This is a complete portfolio system where we offer up both the stocks that are passing the quantitative filters for each of the 4 groups. We then also have predefined sell or delete rules for this as well. So this is a complete portfolio system for the Stock Superstars report. Then on a monthly basis, if there have been any stock deletions over the prior month, in our monthly printed newsletter, which is also available online for our digital-only subscribers, we then replace any stocks that have been deleted from the portfolio over that given period of time, maintaining 10 stocks for each of the 4 guru portfolios. And then in the newsletter, we provide in-depth reviews of any stocks that are added to the portfolio, as well as a rationale for deleting any stocks from the portfolio for that month. And then each month we also offer a variety of educational content covering, investment principles in general, talking about the individual stock screening strategies, etc. So that is all that is available with the Stock Superstars report. Actually, as a thank you for attending tonight's webinar, we are offering a $1 trial to the Stock Superstars report to all attendees. So if you go to the URL at the top, https:// tinyurl.com/SSR trial. You can pay $1 to get 1 month access to the Stock Superstars report. You can see how we are using the O'Shaughnessy screen to build our O'Shaughnessy portfolio. But then you're also getting access to portfolios that are based on the selection strategies of 3 other well-known and highly successful investors. Again, William O'Neill, David Dremin, and John Neff. So actually, this first time I've given that presentation, and things always go longer in the review. So I have given ourselves plenty of time for questions tonight. But this concludes my remarks. Thank you very much for spending your evening with me. And Derek, hopefully you're prepared, but I'm ready to take some questions.
Yeah, no, definitely. Thank you, Wayne. That was a great presentation, very informative. Thank you very much. There definitely has been a handful of questions that have come in. So let's get to those. Let's see. There was a question. A member asked, can you talk about the process of why AAII added price to book value ratio to the value composite? Just talk about the process and how you came up with that factor.
Well, this came about actually. I alluded to the fact that at one point Jim O'Shaughnessy was writing an article for the AI Journal and was doing some research and some data crunching, actually using our Stock Investor Pro software. We talked about we were talking with him as an organization about use of the price to book ratio, and I was not involved in those conversations. So this is this is somewhat anecdotal based on my own thoughts. But if actually if we can get back, I'm gonna go back to this. All right, come on. There we go. So yes, the price to book ratio, it did very well from 63 to 75. Since then, it's had somewhat disappointing results. But I think ultimately why, because actually Jim did include price to book, I believe, in the 4th edition of his book. But since then, his discussion of it has dropped off. And I think part of the reason why is that from 2013 through 2018, it did have relatively poor performance. But we do, rightly or wrongly, we still very much strongly believe in the Fama French research that was done in the early 90s, which does show that the price to book ratio performed very well. So based on that, we did decide to add it back in. Because again, it might be limiting our upside performance a little bit, but as I also discussed previously, there's no way of knowing over any given time period which value factor will be performing well or poorly. But overall, as this slide 16 shows, that a composite of value factors definitely provides you with protection by picking the wrong one over any given period of time. But also that composite actually generates more promising results than relying solely on an individual factor.
All right, thank you. We do have a bunch more questions coming through. There's one that says, do you feel that these screens are currently useful given the number of business earnings restatements and artificial stimulus over the last 3 months and possibly continuing indefinitely? Trailing 12 months numbers now seem misleading. So I think the member is asking about the fact that a lot of these are backward looking.
Absolutely, and that is, doesn't matter what business cycle, what market cycle you're investing in. All of these metrics are definitely backward looking, and so you have to. Part of that is the attendee properly pointed out, is is what's happening now going to be what is happening in the past, a year ago, 2 years ago, 3 years ago, and where are things we think are going to be, 6 months, 12 months, 1, 2, 3 years ahead. Definitely what's been going on does present some unique circumstances. Will definitely, even a year from now, currently as companies are reporting earnings, it's creating problems doing a year-over-year analysis. And then a year from now, it'll also pose some unique challenges. I think right now, if I am still investing right now, I'm fortunate enough where I'm able to keep putting money into the market. I do periodic injections into my portfolio. But I think what I'd be most interested right now is I'm definitely focusing very strongly on quality. So I'm looking at companies, making sure that they have a strong balance sheet, that they are generating the free cash flow to cover any obligations they have, and things like that. So I still firmly believe that these screens do have a place in the current operating environment, investing environment. But as the member absolutely correctly pointed out, we are in a unique circumstance. So if nothing else, I think that requires us to be a little more analytical, and at least in my opinion, probably trying to be looking for companies that are financially strong, and to be able to weather any potential storms that we might be seeing, over the next 6 to 12 months.
Excellent. Thank you, Wayne. There's another question that came through from a member asking, I think they wanted to get in to your mindset in how you
it's
balance.
A scary place, Derek.
how you balance, because this is very quantitative. So these companies have to meet certain factors, certain thresholds. They just wanted to understand the way you think about then your qualitative vetting process as well, how you balance those two.
Honestly, because when you have a 10 stock portfolio and you're running a screen that might be generating 10 to 15 to 20 stocks at a given point in time, there's definitely some you have to play sort of an eeny meeny miny mo situation. I do a lot of that is based on the quantitative filters themselves. So if I do, like in the case of the O'Shaughnessy screen, because you are using multiple factors, you're using 6 factors for the value and 4 factors for financial strength. For example, I will give, rightly or wrongly, but this is my methodology, is I will place, look for those stocks that have more of the underlying factors that for each of those. So for example, if I'm a toss-up between 2 stocks, but I see that it only has 3 of the 6 value factors, value elements populated, whereas another has 6, I would definitely weight that a little bit higher. So there is some additional quantitative parsing that I do when I'm making my selections. But when it comes down to ultimately the question is what my qualitative vetting is, and very simply, a lot of times it's pulling up the news. A lot of things can pop up pretty quickly when you start reviewing the headlines for a particular company. So, it doesn't hurt to look at, we use TD Ameritrade to manage our accounts. And I love TD Ameritrade because their news section, it gives you all of the news for all of the stocks in your holdings. So it's really easy to do that news analysis there. I also, will look at, actually not look at, but read over the conference calls, analyst earnings calls. Specifically, actually, I will skip over, for the most part, the management discussion and jump right to the back. Seeking Alpha will give you normally the full transcript of earnings calls, but I jump to the back and actually review the analyst questions. This is a really good way. I have a financial background. But these analysts that are covering these companies, that's basically all they do. They might have a handful of companies, but they live and breathe the company that they're sitting in on that particular conference call. So they know exactly what to look at for these companies, and they know what questions to ask. So I will review these earnings calls, review the transcripts, and review the analyst questions, and oftentimes even reading through that with my level of financial knowledge and whatnot, I can get a feel for, oops, this is something that might need to be concerned about with a company, or this might be something that could be really a benefit for the company down the line.
No, definitely. That makes a lot of sense to me. It's a similar process I use for the qualitative vetting. Like you said, these analysts, that is their focus. They focus on a specific industry sector. So just listening to the types of questions they ask, you can really get up to speed quickly on a company in terms of what some of the challenges might be or opportunities facing a particular company. So that definitely makes a lot of sense. I did have another member ask, you one of your first slides, you showed a handful of gurus, and the question from the member was, how often do you change the gurus that are being used for the 4 different portfolios that make up the overall stock superstars?
Well, I've been involved with the Stock Superstars report from day one, January 1st, 2002. And over that period of time, we have 4 portfolios, 4 different stock selection methodologies. Group 1 uses the William O'Neill approach, and Group 4 uses the John Neff approach, both of which are originals to the portfolio. We are now using David Dremen's with a twist strategy, also includes estimate revisions. For Group 2, that we've been following that strategy since September 1st of 2006. And actually, we've just at the beginning of May switched our Group 3 portfolio to start using the O'Shaughnessy methodology. The primary factor was the Group 3 strategy definitely was somewhat lagging the other 3, but we that was more of a fundamental factor portfolio, and based on doing a lot of research, looking at Jim O'Shaughnessy's multi-factor approach, and the fact that we were looking for a 4th guru to actually have 4 specific gurus. So the O'Shaughnessy one is the newest by far, but our track record shows that we takes a lot for us to switch a methodology. We have to have the conviction when we go into and start with a strategy, and we're going to let that play out. And very rarely do we switch.
Okay, excellent. Thank you. And this next question from a member kind of follows along the similar train of thought. The member commented, he said, it is hard for an individual investor to keep track of 36 stocks, let alone 40. He goes on to say that there is little difference in risk reduction. Why not reduce the number to a more manageable number like 20 to 25? So I think a broader question, how did you come up with the number of stocks in the portfolio, and how do you think about diversification across the 4 portfolios?
Well, when we launched the SSR portfolio in 2002, our primary focus was diversification, both across selection style, but then also sector and industry. So diversification across style, that's why we're using 4 different selection strategies. Group 1 tends to be more of a group of a growth price momentum approach. Group 2 is value, but it also adds in then earning surprises and estimate revisions. Group 3, the O'Shaughnessy approach, uses more of a factor-based investment strategy. And then Group 4, the John Neff, is more of a growth at a reasonable price, using the dividend-adjusted PEG ratio as its cornerstone. So we're achieving diversification across style using the 4 different method strategies. Then we do pay attention to some extent for sector and industry diversification. But what we discovered, at least what I observed over my time with the SSR portfolio, is that even the most involved in any subscriber, even those that are completely all in with the idea, almost none of them were invested in 36 stocks. Instead, they were either cherry picking or they liked to I liked the group 1 strategy, so I'm going to invest in the group 1 strategy, and I might like the group 4 approach, so I'm going to invest there. So there was more of a hyper focus amongst individual groups. So my rationale when we actually did the redesign of the SSR a couple of months ago, my thought process was that getting feedback from our subscribers, talking to subscribers, is not a lot of them are viewing this as an overall diversification across 4 different groups. In effect, if you are a Stock Investor Pro subscriber, a Stock Superstars Report subscriber, you have access to 4 portfolios. And so by upping it to 10, it's actually helping those people that are only interested in a growth and price momentum strategy, such as the Group 1 annual approach. So we're giving them more options if they want to do a hyper focus within those individual groups. So yes, if you are trying to capture the overall strategy, which I feel very strongly in saying that almost none of our subscribers do that, then yes, a 40 stock portfolio does make things more difficult to manage. But I think if you're more inclined to fall in love with a given strategy, which I think is what a lot of our subscribers are doing, then having a 10 stock portfolio allows you to achieve a greater level of diversification within that specific selection strategy.
Great. I think that's helpful, and it does kind of segue into this next question. I think you touched on it, but I'll ask it anyways. A member asked, how would an index fund investor get started with stock investing? I guess, so just to add on to the question, how would a member decide which group to start with first? What questions would they ask themselves?
Well, and that's you alluded to that. Index funds, mutual funds are a wonderful thing, and they serve a very useful purpose for a lot of investors. A lot of investors either don't have the time to manage a portfolio of individual stocks, let alone do the analysis to arrive at stocks to add to the portfolio. That either is also people they don't believe they have the knowledge, which hopefully if they're AAII members, they are getting that knowledge to become able to invest in individual stocks. But I think ultimately it comes down to it's fear. And it's ultimately, where do I start? And so that's what this question asked ultimately is. But before you do start, I strongly recommend that you do some self-reflection. I'm not trying to get all zen here or anything like that. But if you have historically invested exclusively in ETFs or mutual funds, you need to ask yourself, why is that? It could have been that you were in a period of your life where you didn't have the time to invest in individual stocks, and now circumstances have changed. So you have to think about yourself. You have to ask yourself, do I have the time to manage, realistically, probably at least a 10 to 15 stock portfolio in order to achieve proper diversification? Whether that's, you don't have to be monitoring it daily necessarily or even weekly, but at a minimum, probably spending a few hours every month looking at your portfolio. And then, once you've decided that, you do that self-reflection and decide, okay, I am at a place, I have the discipline, the confidence to start investing in individual stocks. Then you have to start asking yourself, okay, what kind of investor am I? So it's that, trying to do that self risk assessment. If you're super risk averse, then you probably aren't going to want to be investing in a Group 1 O'Neill portfolio that is heavily steeped in price momentum. These are some high flyers. They have some high PEs, high growth, but they can move very quickly and sometimes not in our favor. So if you are more of a value-oriented investor, then we've definitely got, Group 4 is a deep value portfolio. Group 2, the Drummond approach, is value as well, with some estimate revisions thrown in there. Or if you've heard what I've been talking about this evening, or if you've read about factors and feel very strongly about factor investing, then Group 3 might be something worthwhile. So it all starts with that self-reflection, trying to get a better idea of the types of investments that suit your risk profile, your time horizon, etc. And if you sign up for SSR, especially with the free trial, hopefully within that month free trial, you can take a look, get a better feel for the individual's strategies, the individual's approaches that we are using to select stocks for each of the 4 groups, and then look at the investments themselves, both in the actual portfolios and the portfolio watch lists, and get a feel for, are these types of stocks that I feel comfortable investing in. And so, sort of a long-winded answer, but I think that's a good way to make that transition from ETFs and index funds and investing in individual stocks using the SSR portfolio.
No, great. Thanks, Wayne. So tonight we've talked a lot about some of the buy considerations, the quantitative filters to buy a stock. There is a question that came across. Can you discuss the parameters consideration used for the sell decision under this strategy? And let's just talk about O'Shaughnessy, or you can choose any of the 4 gurus.
Well, and that's the beauty of it is, there is a lot of lip service given to, how to pick winning stocks. Inevitably, if you've signed up, you're probably getting an email a day at least from someone, somewhere, some company, if you're an active investor, telling you these are the stocks you should buy. So a lot of information is out there as far as what stocks you should be buying. There is, disproportionately little information or time spent discussing when to sell. And in my opinion, the sell decision is as important as the buy decision. So if you are more of a quantitative investor, if you're following a quantitative strategy, you can flip those buy criteria on its ear. We didn't talk about it here, but I'll refer to our shadow stock portfolio, where you invest in stocks with a low price to book value, a low market capitalization, and then basically we sell when the price to book and the market cap go 3 times above where the cutoffs were at the time that you bought them. So you actually are in effect using the quantitative buy rules to create a quantitative set of sell rules. The key is to allow for a sufficient amount of quote unquote deterioration in the fundamentals that led you to buy it in the first place. When it comes to valuation, pardon me, ideally valuation is going to be expanding because the price is going up. So from that standpoint, we're not going to complain if our value stock that we bought is rising in price. At some point, though, valuations start beginning to normalize, perhaps even getting a little frothy, at which point then you have to consider, are there other value investments out there that I can sell this and then put my money into these? In the case of O'Shaughnessy, so we're using these 3 different composites: financial strength, value, and earnings quality. In order to be considered for the portfolio, a stock has to rank in the best, quote unquote, 20% for all of these composites. So then the question becomes, at what level do we let these things deteriorate? And ultimately, that's, in my mind, I would probably you'd want to, give it some room to run still. But once things start dipping down to when they start falling at least into the bottom half of things, the bottom 40%, 30%, especially if you're seeing multiple, more than one of these composites deteriorate to that level, then you definitely have to start reassessing what's going on. On the value side, again, hopefully valuations are increasing because the price is increasing. I would probably let the valuation go a little bit farther if that is the case, and it's not because the underlying fundamentals like sales, earnings, book value, et cetera, are deteriorating to change the overall valuation. But I would be a little more stringent, especially as I alluded to earlier in this current market environment. I wouldn't let the financial strength or the earnings quality deteriorate too quickly. You don't want to give up any margin of safety you might be having in these companies. So so ultimately, though, doesn't matter if you're using the O'Shaughnessy strategy, AI's model shadow stock, any type of quantitative selection strategy. If you have a set of buy filters, then you can use those same filters, just relax them to whatever level that you feel comfortable with, but then you can use those to navigate when to sell.
Great, thanks, Wayne. I know we've gone over a few minutes, but do you have time for a handful of a couple more questions?
Well, luckily I don't have to go into the office tomorrow, so I have as much time as we have questions for.
You're in your office right now.
Yes.
Excellent. All right, definitely. We have a few more coming through. There's been a few related to. I'm just going to paraphrase here. Questions. People that are new to investing, they have some money to invest. How do people get started? Do they buy all at once? Do they phase it in over time? Do you try to be equal weighted when you start to build your full portfolio? Could you just talk about getting started?
Well, I'll keep it within the context of the Stock Superstars report. I would definitely spend some time learning about the different strategies that we are using in the portfolio. So in this case, get to know the 4 gurus that we are using for our 4 portfolio groups. Get a feel for whether or not you like the strategy the way it's described, if you feel that's a strategy that fits the type of investor that you are. So that's the first step. From there, the brokers did us a huge favor by cutting commissions to 0, so you don't have to worry as much about your expense ratio anymore. But whether you're investing across all 4 groups, only 1, 2, etc., I am very much an advocate of investing equal dollar amounts in each of the stocks that you buy. So if you have $50,000 and you want to buy 10 stocks, then you're going to be investing roughly $5,000 a piece, whether that's 10 spread over all 4 groups, 5 in 2, or buying all 10 in 1. That very much is dependent on whether your comfort level in the individual strategies that we follow.
All right, thanks again. There's a few questions that they want to know your thoughts on the watch list versus what's in the actual portfolio. There was a specific question about why is Navi not in the current SSR portfolio. Can you just touch on that for a second?
Well, because we are constrained to 10 stocks, so that is primarily why. Group 3, when we launched this in May, we had 10 stocks in the portfolio that were selected not using the O'Shaughnessy approach. We didn't sell all 10 wholesales. So over time, we've been a little more aggressive on the sell side within that group 3 to replace the legacy stocks using the old strategy to rotate in the new O'Shaughnessy stocks. But ultimately, it comes down to, again, we have 10 stocks in a group. Navient actually, I think, is a relative newcomer to the watch list. So it wasn't on the watch list when we made our last set of additions and deletions at the last month. So that ultimately is why Navient isn't in there. When it comes down to, the watch lists are a new addition to the SSR portfolio. We used to have what were called ideas, where basically we're on a daily basis, we were just running the pure quantitative strategies, quantitative screens that we use for each of the 4 groups, and that was it. The watch lists now take our quantitative filters, so we arrive at those stocks that are passing our quant filters for each of the 4 groups. But then I'm going through and actually doing some additional, the same vetting process that I would go through if I was looking to add a stock to the actual group portfolio. I'm performing that same type of analysis to add a stock to the watch list. So I think I touched on the watch list serve 2 purposes, one of which is somewhat selfish to me. On a given month, we might sell a stock from group 3. And so instead of me saying, okay, I have to replace a group 3 stock now and basically start from scratch, running the screen, trying to identify some candidates, et cetera, I can instead say, oh, look, I have a watch list of, ideally 10 stocks, 10 companies that I know meet the criteria for the O'Shaughnessy strategy. But then I've also done some additional vetting on them to, throw out any potential, looked at liquidity requirements, done some news reviews, read through the analyst calls and things like that. So the watch lists serve a purpose for me because if we delete a stock from a portfolio, I have a ready-made group of stocks that I can pick from to make that replacement. But then also for subscribers, you might look at this and say, okay, these 10 stocks in the O'Shaughnessy portfolio, I don't like any of them. A bunch of stinkers in my mind, or they're just, I don't like the industries they're in, or I just don't like the business models. Whatever the case may be, a subscriber might not look like the stocks that are in the actual portfolio groups for the 4 groups. They can go to the watch list though, and they're additional ideas. Now, the caveat being there's no guarantee that a stock that's on the watch list will ever appear in the actual portfolio group, but these are stocks that would, if we did need a stock, then it would be from that pool that we would draw from. So ultimately, the watch list from an end user standpoint just provides you some additional ideas.
No, that's great. Sounds like there's a lot of additional ideas. There's an extra level of vetting that happens. So no, I think it's a great improvement for the stock superstar portfolio. I think we'll just take one more question, and this one has come across a lot. And my initial response would be, hey, just try the trial, and you can have access to all the performance data. But there has been a lot of questions. Just people would like to know how the 4 strategies are performing in general, and versus the IYY. If you could touch on that.
Well, the group 1, 2, and 3 are all outperforming the IYY since inception. I don't have that data in front of me, but it is groups 1 and 4 historically have been by far our strongest performers and have outperformed the IYY since 2002 by, I think, at least an average of at least 100 basis points a year. Group 2's performance outperformance is much narrower, maybe about maybe 20 or 30 basis points a year. Group 3, though, is an entirely new strategy. It's up, I think, 13% this month, so it's definitely our best performing group this month. I'm not saying that that's going to happen every month. I'd be shocked if it did, but that is, a very small sample size. But Group 3 is doing very well this particular month, but because it was only launched in May, we don't have long-term performance figures for it. So, we feel very strongly in the strategy. We did some back testing before we actually went live with this to see whether or not this is a strategy that we think would be worthwhile, and we were very encouraged by the backtesting results that we had. So hopefully that backtesting turns into real world outperformance.
Well, that's great. Thanks again, Wayne. You know, this presentation has been very informative. Thanks for taking all the questions. Would you mind just forwarding to the last slide, please? I'd love to tell everyone about the upcoming webinars.
There you go.
All right. Okay, I just think there's a slight delay, but I think it'll come across. But in the meantime, you know, as always, you can view the full listing of upcoming Wednesday webinars at www.AAII.com/webinars. And be sure to tune in to next week's webinar, where Craig Israelson will be talking about retirement portfolio analysis, a multi-decade review. And then the following week, we'll have Wayne back, and this time he'll be talking about making the grade, talking about factor investing with A+ Investor. And then the following week, we have Charles talking about introducing the AAII way for creating a wealth plan. So thanks for joining tonight. This concludes tonight's webinar. Thanks for attending, and everyone, please stay healthy and safe. Thank you.